everyone, and thank you for joining us. Today we're going to be discussing the performance of the Sasfin Global Equity Portfolio. And to help me unpack the numbers, I'm joined by Craig Pfeiffer. Hi, Craig.
Hi, Jonathan. It's been another interesting quarter for the portfolio and for the markets, so looking forward to chatting about it again.
It certainly has been an interesting quarter. I think prior to this quarter, the past three were positive for global equity markets, but not so for the third quarter of 2023. It was a negative quarter. Maybe you can just take us through some of the reasons why global equity markets fell during this period.
Yes, I think, there's probably a couple of reasons. One quite basic one, I suppose, is generally there tends to be a seasonal time of weakness in the markets if you look on average, and that's typically August and September. So October's not historically the worst month of the year for markets. But that aside, I think the big macro elements that were playing out were the main driver of the weakness. And that's this concept of interest rates staying higher for longer. The market over the last year or two has been anticipating when the Fed will stop increasing rates and when we'll finally start seeing rates cut again. And in this last period, the latest thinking was, and it came from the Fed as well, that interest rates could still go up a little bit more and maybe stay higher for longer than the market was expecting. And that was a bit of a blow to the markets, and they took that as a sign to kind of adopt more of a risk-off approach. So we saw the dollar strengthening, we saw bond yields, US Treasury yields kicking up to levels last seen at the time of the global financial crisis. That's how high they got. And even commodity prices came off, and it was all really just retreat into the dollar. You didn't want to be in bond markets, you didn't want to be in equity markets in the last month or two or quarter. So I think that's how things have played out in the background, and particularly for a lot of the stocks in our portfolio where earnings are expected to come in future years and really start building up in future years. When you start having higher rates, which translate into higher discount factors, that translates into lower valuations. And I think all of that, in conjunction, just put the markets on the back foot in the last quarter.
And apart from the interest rates and economic growth and those type of factors, I think China was also a bit of a black mark during the quarter. Maybe just take us through some of the things we see going on there.
Yes, so we've been hoping, for the whole year really, after China had passed through its COVID phase and the cities had opened up, lockdown was a thing of the past, that China would really start gaining momentum and grow at a 5 or 6% pace or even faster this year as it kind of rebounded. But we haven't seen that very much at all. And that's had quite a broad influence on the likes of commodity prices. If China's not growing, they're not demanding those goods, particular commodities from the rest of the world. And we've seen it even in the luxury space. Just demand has been slow. And that's impacted on a lot of the companies that are global and that have a reach into China. Nike, for example, as well. Consumer companies that depend on Chinese demand have all been really not picking up as one would have hoped for.
You mentioned Nike. Maybe that's a good time to transition into the individual performance of the stocks and our portfolio. So global stocks were down. Our portfolio was down, but more so than the broader market. And you touched on one of the reasons, interest rates. I think broadly interest rates negatively impacted stocks. Us more so because of the longer duration of our holdings. But maybe just pulling back a bit, the Chinese story did impact a lot of our stocks, Nike, LVMH. Maybe you can just touch on that slightly, and also some of the industrial stocks as well that were negatively impacted.
Yeah, I think particularly in the luxury space, the portfolios own LVMH, and China and travel is a big part of where their revenues come from. And with the China not growing, we like to think that very high-end luxury space is quite defensive, and it is to a degree, but not totally immune to a slowdown in activity. So the likes of LVMH, their revenues, they came out post the quarter, but looking back, they were softer than expected, and that happened for the whole luxury sector as a whole. In the consumer space, I think as you mentioned, Nike, they are also open to Chinese demand for their goods. They have their own particular issues that they've been working through, high inventories for the like, changing their model to direct to consumer a bit. So there's an element of a niche element in the company itself, but still you need those end consumers to be buying your goods and services at the end of the day. So Nike, LVMH, I think some of the industrial companies that are engaged in the area as well have also seen a slowdown in revenues on the back of a slower China.
Yes, I think Siemens, one of our holdings, their digital industries business, a lot of Chinese companies automating their factories. The slowdown in China obviously impacting orders for those automation type of events for their companies. Another industrial company that we hold that had a very difficult quarter, RTX, formerly Raytheon. Maybe you can just take us through what happened there and maybe just briefly mention what our approach has been.
Yes, Raytheon or RTX Corp, as they were renamed, in the aerospace and the military side, and we like to also think of them as defensive in the defense arena. But during this period, during the last quarter, they came across a fault in the composition of the material that they put in their Pratt & Whitney jet engines. So the long and short of it is that they essentially have to recall those engines, have a look, open them up, see what if the parts need to be replaced in the engines. So there's a cost to them of replacing the engines or that piece of the engines. There's a cost of the downtime to the airlines, which they would have to compensate them for. And we're talking thousands of engines. So there's thousands of planes that require this additional maintenance or inspection, and a sizable claim from the airlines for the downtime, the lost revenue that the airlines would incur. So there's a bill that they put on it. They firstly announced it, and they kind of said, it's not really going to impact cash flows too much, but it seemed a little open-ended. They came out subsequently, so the price fell off after that. Then they came out with an announcement that they're probably going to put $3 billion aside for potential liabilities and corrective action. And at that point in time, we thought, look, that could be the be-all and end-all of it, but it's still an open-ended liability. We don't know how much more they might have to pay and how it's going to impact the company. We took the decision then to exit Raytheon at that point in time. Fortunately for us, I suppose for our clients, the stock still fell further after that. And we still like the company. It's still a good company, but if you've got this open-ended liability, it's just steer clear of the uncertainties, and we can reconsider it in times to come. But we took the decision to exit it and put those troubles behind us and the portfolios for now.
Yes, and I think broadly most stocks were down during the quarter. There wasn't much place to hide, but the one area of the market that did actually perform quite well during the quarter was the energy sector, particularly oil stocks, given the rise in the oil price. So our holding in Royal Dutch Shell, that performed quite well during the quarter. But there were one or two other stocks that actually performed relatively well, given what happened in the markets. Two particularly that are still benefiting from the AI theme that we've seen driving the markets this quarter. One is Alphabet, the other one NVIDIA. So NVIDIA is still riding the tailwind of this rush towards building out these AI models. NVIDIA supplying the chips used to train the models. Probably less spoken about, but still very big in AI, possibly even the biggest AI company, though most people might not realize it, is Alphabet, the parent company of Google. So they're very big into AI. They're building, I think, what's going to be the largest model. It's going to come out soon, called Gemini. But what I also wanted to mention about Alphabet as well as Amazon is that those two companies are now facing antitrust issues in the US. They are being accused of running monopolies. Alphabet running a monopoly in search. Amazon accused of running a monopoly in their e-commerce business. We're going to have to wait and see what happens, the outcome of those trials. But from our point of view, it's probably going to be very difficult, but not impossible, to prove that these companies are running monopolies given the way US antitrust law is currently written. So for now, we'll just watch them closely, keep an eye on it.
No, I think that's quite important, is that there's times to act when there's uncertainty, as we did with Raytheon. But in the case of these two companies and Counters, there is an element of uncertainty. But even if it plays out like that and they have to distribute the companies, it may not be a bad thing even at the end of the day for shareholders. They've got cash flows to pay big fines. Look, hopefully we don't have to go there, or if that's the outcome of it. But we think these companies are big enough to withstand whatever the outcome might be. And maybe the worst of it is that they have to hive off a company or unbundle, and maybe that even unlocks more value. So I think that's the prudent approach, is a wait and see in that front.
So Craig, we exited our position in Bank of America. Maybe you can just go some of the reasoning or the rationale for that decision.
Yeah, I think with Bank of America, firstly, we're in this environment of increasing interest rates. And typically with banks, as interest rates go up, there's an initial benefit to the banks, particularly as interest rates go up, they earn more on their loans, and they reprice those instantly. Whereas their deposits, they might be a little lag and will start putting up rates at the end of the month or a little later. So in short, there's a positive, what they call endowment effect of the higher rates. As interest rates go up, banks benefit generally. But then at some point in that cycle, in high interest rates, you start getting delinquencies, or people can't pay back their loans. So then those higher rates start having a negative effect, and the banks have to make good on, or just have increased liabilities, more and more bad loans and the like. That's typically how the cycle works. But I think with Bank of America, they were poised to really benefit and be the biggest beneficiary of that endowment effect and higher rates, which didn't really play through in the company. But probably the biggest reason we've exited Bank of America is from the point of view that it embodies leverage, and we like companies actually that don't use leverage as much. So that's probably, let's call it a structural reason to get out of it. But I think there were also, the macro environment, and then probably the timing was right to just exit Bank of America.
Yeah, I think that's a wise decision on our part. And I think in general, we probably wouldn't look to invest in banking companies given those reasons. The other company that the change we made was to invest in a company called Constellation Software. A lot of people haven't heard of this company before, but it's a Canadian-based software company, and they're what you'd call a serial acquirer. So they specialize in acquiring other businesses. In their case, it's smaller software businesses, specifically vertical market software companies. Vertical software is basically software that's made for a specific niche. Perhaps you're running a harbor at a specific part of the world. Someone's made a very specific piece of software to operate that harbor. So they don't have any competitors. They're the only company that has the software in that space, and it's part of that vertical, as opposed to maybe more horizontal software that, Microsoft Office being a good example there. I think the reason, or the reasons we got into this company, one is the management team is exceptional. They've got an exceptional track record of deploying capital. They are able to acquire these businesses at really good prices and extract synergies out of them. Any cash or excess cash that the business generates, of which it generates a lot, they redeploy into other acquisitions. So they typically make quite a few acquisitions during the year, quite small ones, maybe $3 to $5 million. They did make quite a sizable one recently, but generally it's the smaller companies they look to acquire. And if you look at the growth of this business over the years, both top line and bottom line, really strong growth. I think it's in the 20% level. Obviously, a lot of that's inorganic, but still really good growth. And as I mentioned, the founder, an individual named Mark Leonard. If you're interested, you could Google him. You'll come up with a very
Interesting character.
interesting picture and his background story, his past jobs. I think one of them was a grave digger. That aside, exceptional management team, and I think the company has a long runway of growth ahead of it, and we should benefit from that growth.
Yeah. No, I share your sentiments. It is a company that really did stand out, and it was one that we could acquire at the right price.
Yes.
We look at all the metrics that we want, quality and growth, but then get to the last hurdle, how much you're going to pay for it. That could ruin a potential acquisition for the portfolio. But we got this one right, and maybe looking forward, the market weakness will help us also on the valuation side. A couple of new companies to bring into the portfolio that have the growth characteristics that we want, they have the quality characteristics, but have just been too expensive. So, a market coming down isn't always a bad idea. It might give us more opportunity to acquire some new counters for the portfolio.
Well, you're alluding to the next topic, which is the way ahead or looking forward. How do you see the economy, the markets unfolding following what's been quite a difficult quarter?
It's been difficult. If we look at things like the S&P, it's still up in the early teens for the quarter. Been through a bad patch. I started to think that as the market starts anticipating, and as time passes, we have to be closer to that point where rates will start falling, and that we have reached the peak. I believe we have reached the peak in interest rates. It's just about when we start cutting rates, or when the central banks start cutting rates. And I think that's going to be a story for 2024, that we'll start seeing rate cuts. 2024 is sort of a couple of months away. And once the market starts digesting that this is the year where rates are being cut, we'll start getting a little momentum, I think, again in the markets. Hopefully that will drive the market higher. But hopefully we've got all the counters that we want before that happens again.
I also think it's quite important to just remember as well that while we do focus on the quarterlies and the next year, we're long-term investors. So regardless of what's happening in the short term, our main focus is still the longer term and how we expect these companies to evolve and grow their earnings. So with that in mind, while we are very cognizant of what's going on with interest rates, with the Chinese economy, our main priority is still understanding the underlying businesses and their long-term drivers, and whether or not the investment cases that are underpinned by those drivers still hold up. And of course, in terms of our approach, it's that quality growth approach. Are they still able to earn high returns on capital? Do they still have attractive investment or opportunities to reinvest into? And of course, as you've mentioned multiple times during this video, acquiring them at the right price.
No, I think that's exactly how we're going to continue to look at the portfolio. Gloss over the short-term stuff if we have to. See it as an opportunity where there is. But and I know we do a lot of homework on companies before we actually do put them into the portfolio. We want to know every bit about them, about their management, about all sorts of things, and they must have a good track record already, a long established track record of the growth and the quality, and then have that outlook for that to continue going forward. So yeah, thanks for all your work in this quarter, Jonathan.
And thank you for joining us today, Craig. I think we can leave it there. And thank you for joining us today. We look forward to seeing you next quarter. Bye for now.